We recently introduced a new channel called Markets by Zerodha. Today's episode is a very special one where we recap the best stories from the previous week that we have covered. I hope you find value in this. Let's begin. So let's begin with something interesting happening with mutual funds. See, mutual funds usually keep a part of their assets under management or AUM as cash. In the case of AMCs, they hold about 5%. Currently, equity mutual funds also hold about 5% of their AUM in cash, which is the lowest level in 5 months. Now here's the thing, high cash levels often suggest that fund managers are being cautious or cannot find good investment opportunities. So when cash holdings drop, it usually means that fund managers are feeling pretty good about the markets. But it's weird when you consider the current market levels. See, Indian markets have been on a non-stop upward trajectory ever since COVID hit. Many experts have been saying that the markets are overvalued and some segments are also in a bubble. So the question here is, does the fall in cash holdings mean that fund managers are ignoring valuations? Maybe not quite. Look, being a fund manager isn't really easy as you would imagine. If they keep too much cash, they might miss out when the markets shoot up. And if they don't keep cash, they are more exposed when the markets fall. So here is something to think about. Are Indian mutual fund managers really value investors, or are they just chasing returns? Maybe a closer look at the portfolios of the funds you have invested in could give you your answer. See, if you're a regular retail investor, you can put your money in stocks, ETFs and mutual funds. But what if you're rich? Well, then you have got some more fancier options like portfolio management services or PMS or alternate investment funds or AIFs. The catch here, of course, is that you need a minimum investment amount. The amount is at least 50 lakhs for PMS and 1 crore rupees for AIFs. Now SEBI recently spotted a problem here. There is a huge gap between mutual funds where you can start with as little as 100 rupees and PMS where you need 50 lakh rupees as minimum investment. They are worried that this gap might be leading to a rise in unauthorized portfolio management and advisory services. So what's the solution, you may ask? See, the SEBI has come up with a new proposal for a new asset class that sits right between mutual funds and PMS. Now let me break it down for you very quickly. The new asset class would require a minimum investment of 10 lakh rupees and could be offered by existing mutual fund companies. This new asset class can use futures and options for more than just hedging. Unlike mutual funds and PMS, it can make directional bets in the markets as well. SEBI is talking about strategies like long or short funds which have both long exposure to stocks and short exposure in the same fund. For your context, mutual funds and PMS are long only. They have also stated that this new asset class can run strategies like inverse ETF. In simple words, inverse strategies move opposite to an index. Say for example, a Nifty inverse ETF will fall if the Nifty index rises and vice versa. Basically, this is a trading instrument to short Nifty without directly using futures or options. SEBI is also proposing to allow higher concentrations for single stock positions, higher limits for risky bonds, and more flexible sectoral exposure limits. In simple words, this new asset class can take higher risk than traditional mutual funds. Now this new proposal is also interesting because SEBI has been trying to slow down F&O participation in the market. This new asset class, however, could be a way for people with higher risk appetite to get into regulated leverage products. It is also interesting that they are now allowing leverage at the 10 lakh rupee level when it is not even allowed in PMSs at the 50 lakh rupee level. Currently, the only way to get regulated leveraged products is through AIFs, which require a minimum investment of 1 crore rupees. But all said and done, it is important to remember that this is just a proposal for now. SEBI is asking for public comments, so we don't really know what will come out of it. Now moving on to the next story, the IMF or the International Monetary Fund recently released its report on the World Economic Outlook update for July 2024. The IMF publishes this report twice a year and it basically gives us a bird's eye view of how the global economy is performing at large. This is interesting because it gives us a good overview of the key economic trends and the forces that are moving the global economy. Let me explain it to you in really simple words. First of all, let's look at what the IMF is saying about the global economy. First, they're projecting global growth of about 3.2% in 2024 and 3.3% in 2025. If you ignore the crazy drop in 2020 due to COVID and the rebound in 2021, we are practically back to pre-pandemic growth levels of around 3%. Second, Most countries are seeing positive growth except the US and Japan, where things have really slowed down. Very surprisingly, Europe, which has been very stagnant for almost a decade now, is slowly showing signs of life too. Now, in that context, let's talk a little bit about inflation because that has been a hot topic for the last 5 odd years. The IMF says that inflation is still falling, but it is slower than before. Why, you might be wondering? That is because while goods inflation has dropped, services inflation is still very sticky. If you're wondering why service inflation has been sticky, let me explain. Look, during the pandemic, everyone was buying things online because they just could not go out. So goods inflation spiked, but services got cheaper. And now that people are out of their homes, they want services again. Hence, there is more demand for workers, which is pushing up wages and keeping services inflation high. In many countries, energy and food price inflation is almost back to pre-pandemic levels. In last week's episode, we also discussed this being a problem in India. Now, because of all of this, inflation might stay higher for much longer. This means central banks might not cut interest rates as much as we'd like it to be. And this, of course, is not great news for the markets. Now, coming back to India, the IMF is projecting a 7% growth for the country. This is up from about 6.8%. And this is because they think private consumption, which has been pretty weak by the way, is set to improve, especially in the rural parts of India. With growth in advanced countries being so slow, India and China are now expected to account for almost half of global growth. Now moving on, let's talk about Zomato. See, Zomato recently raised its platform fee from 5 rupees to 6 rupees in some metro cities. This is the 5th increase since it was first introduced in August last year. Now if you're wondering why, it's probably because Swiggy started charging a similar fee back in April 2023. Considering food delivery is a duopoly between Swiggy and Zomato in India, it was relatively a simple way for Zomato to increase its revenues. Now Zomato also had the option to keep the platform fee at 0 rupees and use this as a way to attract users from Swiggy. But why it was a hard call is because of two main reasons. First, Zomato is a publicly listed company. This means it has to keep its shareholders happy. And these shareholders expect to see profits grow consistently. And second, the upcoming IPO of Swiggy adds another layer of pressure on Zomato to maintain competitive pricing strategies and keep its investors happy. Now, because this is a market with just two players, Zomato and Swiggy enjoy a significant pricing power. This means they can comfortably raise their prices without worrying about losing too many consumers. Long story short, people don't quite have a choice. Now this is not just an Indian thing. Global companies like DoorDash and Uber Eats also charge a platform fee. They just call it using a different name, which is service fee. Now speaking about the platform fee, Zomato's management had earlier said that the introduction of platform fee has greatly helped their revenue along with better ad monetization. The CFO of Zomato, Akshant Goyal, also mentioned that the company believes that the platform charge currently is too small to affect consumer behavior. He said that Zomato might keep experimenting with the fee amount, but they are not really planning to get rid of it anytime soon. Now, if you're curious about how much money Zomato can really make through this 6 rupee fee, let's do some quick and dirty math. With about 22 to 25 lakh orders every single day, a 6 rupee platform means that Zomato makes close to 1.5 crore rupees every day. That's about 45 crores a month and 550 crores a year. That is some big money to let go of. Now moving on, now see, in many of the previous stories, we have discussed India's youth unemployment problem. About 50% of India's population is aged between 18 to 44 and a major unemployment problem is troubling this age. This problem is mainly because of skill gaps as well as pay disparities. Now, one space that is really rewarding skills and hard work with good pay is the gig economy. According to Niti Aayog, there are over 2.5 crore gig workers in India, which is crazy considering that these gig platforms didn't really even exist a few years back. But considering the fact that these platforms are growing rapidly, these numbers are bound to be higher in reality. According to BCG or Boston Consulting Group, the number of gig workers in India could increase by 5 to 10x and reach 90 million in the next 10 odd years. Now, according to a data from 2021, most gig workers in developing countries like India were younger than 35 years. This means these people are finding it hard to get well-paying jobs. But here's the thing, it's not all nice and rosy. As of late, there has been some growing concerns about the gig economy. These jobs don't really classify workers as employees. This means there is no job security, there are no benefits, wages are irregular, and employment status is uncertain. And this uncertainty has been causing a lot of stress for these gig workers. To solve this, the Indian government has classified gig workers as unorganized workers. This means they are eligible for some social security benefits. In July 2023, the Rajasthan government was the first state government to introduce a bill to protect gig workers. Recently, the Karnataka government has also followed the same footsteps. They recently introduced a draft bill to provide social security and welfare for platform-based gig workers. The bill proposes a few important things for gig workers which you should know of. First, all digital platforms and gig workers need to register with a new welfare board within 60 days. Second, the government will set up a welfare fund for registered gig workers. Third, platforms need to provide fair contracts and 14-day notice for terminations. Now again, while all of this might be intended to be a good move, there are some concerns that people and journalists have highlighted. First, the bill still does not solve the main problem, which is it still does not call gig workers as employees. Instead, it still treats them as independent contractors. Because of this, they will still miss out on many important benefits that an employee would otherwise have gotten. Second, the bill talks about welfare fees, but it does not say who will pay for them. Companies or customers, we don't quite know. This could affect how much gig workers end up earning in India. Third, the bill does not really talk about what companies should do if customers misbehave with workers. It's silent on these kind of important issues. So while the bill tries to help gig workers, it leaves a lot of important questions unanswered. But the good news is that Karnataka's bill is still a draft, which means multiple changes can be made before it is finalized. We will talk about the unreal growth in SME IPOs. See, in FY 2024, about 130 SME IPOs went live on NSE and they collectively raised 4622 crore rupees in the markets, which is a record high. For comparison, SMEs had collected about 2455 crores in FY 2018, so the growth has been unreal here. Now, if you recall, we discussed SME IPOs in an episode last week as well. We spoke about how SME stocks and IPOs have fewer regulatory requirements than regular IPOs. This is so that they could raise more capital easily. But instead, now this has led to frauds and scams in the SME segments. To curb this, a few days ago, NSE had imposed a 90% cap on the listing price above the issue price in the pre-open session. Now, in simpler words, that basically means that 100 rupee stocks at IPO cannot list at more than 190 rupees. And this was done in order to reduce speculation and volatility in these IPO listings. Now, because of the spectacular growth in SME IPOs, this became a retail favorite. Some even went to the extent of considering SME IPOs to be a guaranteed money-making scheme. Now, there is a very interesting editorial article in the Hindu Business 9 that talks about this topic. The editors discuss 4 interesting changes that, if implemented, can reduce speculation, scams, and fraud in the SME segment. First, they propose increasing the minimum subscription amount from 1 lakh rupees to 5 lakh rupees. The reasoning sounds fair as well. The 1 lakh rupee rule was introduced back in 2012 to keep away those retail investors who may not be able to bear the risk associated with SME IPOs. But 1 lakh rupees does not seem to be a very big constraint anymore in today's time. And therefore, an increase in the minimum capital would be very important in order to curb these risks. Second, they talk about significantly lowering the 90% limit on listing day gains in the pre-open session. The rationale behind this is that the 90% cap is too liberal and it will attract speculators. And this is true even though 40 of the 130 odd SME stocks that IPO'd on BSE and NSE delivered over 90% returns on the listing day. The idea here is that if a stock is good, it will do well. Third, they suggest that these rules need to be implemented simultaneously on BSE and NSE for them to be very effective. This is because both exchanges have around 300 SME stocks each. If price gain on one platform is curbed, it will only result in speculators shifting to the other one and it will only create more problems. So while all this is only a theory for now, if implemented, this could solve many of the problems that SEBI faces with SME IPOs as on date. Now I'll remind you that this is just Hindu Business Line's opinion and SEBI has not yet hinted or mentioned anything about changing how SME IPOs work. But as they say, where there is smoke, there is fire. Let's now talk about something interesting that is happening in the world of bank lending in India. The RBI recently released its credit growth data and there are some fascinating trends to look out for. But first, for context, credit growth data shows how people are borrowing and how banks are lending. Now before we get into the details of this, let me give you some background. See, before the pandemic hit, credit growth was pretty much very weak. In simple words, banks weren't quite lending too much. But post the pandemic, credit growth has been spectacular, especially in personal loans and in credit cards. RBI's latest data reveals some very interesting insights. Overall credit growth is at 16% year on year. For comparison, it was just 6% in July 2021. This shows the total money lent by banks across all categories. But after hitting a peak in December 2023, it has been pretty flat. Second, personal loans are growing at about 18% year on year. But there is something interesting happening here. In November 2023, the RBI increased the risk weight for unsecured personal loans and credit cards. This means banks had to set aside more money for every rupee they lend in these categories. Now, why did the RBI do this, you might be wondering? Well, unsecured loans were growing too fast and the RBI got worried. So they made it more expensive for banks to give out these loans. And seems like it might be working. In November 2023, unsecured loans were growing at almost 22% year on year. But as of May, this growth has dropped to 17%. Now here is where it all gets really interesting. Banks seem to be shifting gears. They're reducing personal loans and instead giving out more agricultural loans. In November 2023, agricultural credit was growing at 18% year on year. And as of May 2024, it has jumped to almost 22%. Now you must be thinking, with all this money flowing into agriculture, the sector would be booming, right? Not quite. See, agricultural growth has actually fallen from high single digits to low single digits despite all this credit, which is very weird. But right now, there is no sign of stress in agriculture really. Bad loans are well under control and in fact have also fallen. Citibank research spotted something very interesting about this. They noticed that in 2008-09 and in 2015-16, when agricultural credit growth outpaced overall bank credit growth, it was followed by very tough times for banks that had given out agri loans. So now the big question here is, will history repeat itself? Well, only time will tell. Well, that's all the news I have for you today. I hope you found value in this. See you in the next one. Take care.